Hey, this is Nash Evans, and today I have the pleasure of meeting with Randy Brunson with Centurion Advisory Group. We are in Jackson, Mississippi. We're going to head to Dexter, Mississippi. We have a drilling rig operating. So tell us, first and foremost, tell us a little bit about your background with Centurion.
Sure. I personally have been around the financial services space for 45 years, and I'm not sure that qualifies me for anything other than 1 year's experience 45 times. But I've been around the financial space for a long time, and just over 20 years ago, my business partner and I put together what's referred to in the financial space as a fee-only advisory firm.
So how long have you been doing fee only?
Actually, almost 30 years now.
Wow. And
Almost
that was
30 years.
kind of before fee only was really
That's
popular.
Right. That's right. The purpose behind that was I personally wanted to be able to serve clients, help them do well financially, help them make good decisions, because so much of our life is built around helping our clients make good decisions with their money. And I wanted to be able to do that without having to depend on the sale of life insurance, mutual funds, annuities, those kinds of things to pay the bills. You know, and so we have created a professional services firm that offers a suite of planning, portfolio management, tax planning, charitable gift work, those kinds of things for a handful of about 100 clients. So we're not a mass market firm at all. We serve
Sure.
about 100 families and simply help them make good, informed, intelligent, prudent decisions about their life. So that was the focus. How do we serve well without having to depend on the sale of financial products to make our living?
Sure.
Yeah.
And actually how we got together is through a mutual contact, but we put together oil and gas private placement memorandums. And with us drilling well, there are tax advantages to oil and gas that most people don't fully understand.
That's right.
Or their CPA doesn't understand them.
That's right.
But
That's right.
There's a huge pocket, and tell me if I'm wrong here, that if you can figure out a way to defer or write off income to make as minimal amount of income as possible, that the amount of tax savings alone just amplifies the rate of return. And a lot of people kind of overlook tax savings when planning long term. Would you agree with that?
I would agree. What I find so interesting is a common word in the current business lexicon is unicorn. And that's startup companies that get to $1 billion valuation very quickly. Unicorns certainly have their place, but here's the situation. These young men and women who are the founders of these $1 billion companies, at some point, you know what they're going to need besides a $1 billion valuation?
What's that?
Cash flow.
Yep.
Cash flow. Because none of us can take our brokerage statement or the joint venture paperwork from oil and gas down to the grocery store.
Right.
Publix, Albertsons, Safeway, HEB, wherever. Okay. We cannot take it down there and slide it through that little piece of hardware.
Yep.
And go home with a bag of groceries.
Exactly.
You know what we need? We need cash.
Well, and you don't have cash flow. There's a lot of people out there that have a high net worth, but they're not liquid.
I have had them stop by my office and I've looked at financial statements of $15, $20, $25, $30 million.
Yep.
Okay. One case just front and center, a couple in the early 60s, and he was a serial entrepreneur and had almost $20 million in assets, could only put his hands on $200,000 in cash.
That is so 1%, less than 1%.
Yes. That is not sustainable, and he wanted to retire.
Yeah.
And that is not sustainable long term. So if you study financial statements, and especially you study business owners, and we work primarily with business owners, one of the things that we help them figure out is how to have consistent, quality, tax-effective cash flow. In a healthy, diversified financial statement, business interest, income generating real estate, marketable securities that pay dividends, cash in the bank so that you can always take advantage of new opportunities.
Yep.
Okay. And oil and gas has a very distinct role in that, because these business owners, they get up and go to work for years and years and years, and 25 or 30 years later, they're an overnight success.
Yeah.
And they have more cash flow than they need, multiples 4, 5, 10, 15, 20 times what they spend. the tax outcomes on that can be significant. So how do we then structure? And that's where oil and gas comes in, because an investor going into a structured offering can go in as in a limited capacity or in a general capacity. And the tax outcomes are different there.
And there is a middle spot, and that's kind of what we do. We structure ours through a joint venture.
Okay.
Because so let's say the businessman that you're talking about,
Yep.
he does have the 20 million, and
Yep.
he's only liquid for a couple $100,000. There comes a point in time that he is going to restructure his net worth
Right.
for retirement. And usually that's selling a business, selling assets. But when that occurs, you have a massive appreciation.
That's
that
right.
the government now can have their hands on the taxes.
That's right.
So we do a lot of 1031 exchanges if it's property. So we do a lot of people that own apartment complexes that have owned them for 30 years. They're wanting to sell out, and let's say they paid $1 million for it, and now they sold it for $6 million. That's a lot of money in taxes.
It's a lot of money.
So utilizing 1031 exchange into oil and gas, they are able to defer the taxes in full and then turn that into residual monthly cash flow.
That's right.
And then 15% of the income is tax-free. And same thing for income. You have one of those really phenomenal income years. The name of the game is write your income as minimal as you can with write-offs, and then turn that back into cash flows. So going back to active versus passive, I'm sure that's what you were referring to. We structure ours in a joint venture. Why a joint venture? Well, they are arm's length transactions. It helps protect the partner from being a direct owner of the wellbore, but it also allows them to have active write-offs associated with it. So instead of you, for say, being a partner in well number 1, we have a joint venture that is partner of well number 1, and you are a partner of that joint venture. My job as general partner is to protect my partners and make sure the jobs get done perfectly. Therefore, you kind of have the best of both worlds.
Right.
You have the tax benefit, you write it off in full, flows through on a K1, but you are also covered by the terms of that joint venture.
Which is a positive. And what I have always looked for in my definition of a private placement that I've developed over the years is if I cannot push a button and go to cash on an investment, it's a private placement.
That's the best way to put it.
And that's a very broad definition because it can include my business and so many other businesses. And when it comes to private placements, whether they are structured in oil and gas or real estate, or if you want to throw in with some of your buddies and just start a more traditional business, it really doesn't matter. The first cut is always the people you're doing business with. I would rather be in what looks like a mediocre deal on the term sheet with people that I trust completely,
Yep.
than in a deal that looks stellar in the pro forma on the term sheet.
Right.
Okay, but the people that I'm dealing with, I'm a little uncomfortable with. And over and over and over across the years, I have found that to be the case.
Right.
And that applies especially over the years. I've watched oil and gas and real estate syndicators come and go. By comparison, there are opportunities in oil and gas and in real estate, and the ownership structure and the people behind it and the decision makers are what I will call Wall Street financiers.
That's right.
If you see those, my highest and best recommendations, if you run across those, is keep your hand on your wallet and run away as quickly as you can.
Sure.
I have never seen a good outcome there.
You're right. The one thing I try to tell anybody, they ask, what else do I need to know after I looked at a deal? Well, you kind of need to know who's the operator, because actually I think that's the most important aspect of it.
Right.
Is who is managing it?
Right.
What are they doing? Do they know what they're doing, or are they sitting at a desk? Active management, I think, is one of the number one token things to look at when you're looking at an oil and gas company. And we'll see that today. You'll get to be on the drilling rig as we're drilling a well. I think we're about 8,300 foot right now as we talk. But so what other questions do you get? If somebody is and one thing I want to point out, everybody is so focused on the stock market or an index fund. There is a lot of deals out there that are not a public market, that are, like you said, small friend groups, starting a new business. There's a lot of other avenues that have the opportunity for greater than market benchmark returns
Right.
that come with tax efficiencies that you cannot get with buying and selling Apple stock.
That's right. That's right.
And then also the premiums. People don't realize that when you buy a stock in the open market, you're buying it at earnings per share. And if you own a business, you can pretty much get a 1-to-1 versus paying a multiple of 20 or 30 to 1.
That's right.
Well, hey, thanks for coming along with us, Randy. Thank you so much.
Nash,
I appreciate
thanks so much.
it. And
Absolutely.
now let's go ahead to the field.
Look forward to it.
All right.
Thank you.